Imagine this. It's the late 1990s, and Fortune magazine is practically swooning over a company called Enron. Year after year, they slap the same crown on its corporate head. America's most innovative company. Innovative at what? That was the question no one seemed brave enough to ask. But if you had even whispered it back then, the reply would have been a cocktail of hype, charm, and, let's be real, downright nonsense. Because Enron wasn't just a company, it was a performance. A Broadway show with energy contracts instead of tap dancers, balance sheets instead of orchestras, and a cast of executives who could make Wall Street drool by just whispering deregulation. But let's rewind a little before the confetti, before the private jets, before Enron was the world's most famous four-letter word. Enron was born in 1985 from a merger of two relatively boring natural gas companies, Houston Natural Gas and Internorth. On paper, this was not sexy. This was not Steve Jobs unveiling an iPod. This was paperwork, pipelines, and guys in suits arguing about gas flow. But in that merger came a man who saw the stage lights, Kenneth Lay, smooth-talking, politically connected, and exactly the kind of guy who could turn boring gas company into financial superstar. Lay wasn't selling energy. He was selling deregulation. See, in the old days, utilities were like your grandma's rotary phone, fixed, predictable, and definitely not thrilling. Prices were regulated, markets were controlled. But in the 80s and 90s, the US started letting private companies play around in energy markets like kids in a sandbox. And Kenneth Lay was standing at the playground gate, ready to charge admission. Enter Jeff Skilling, the man who would later be described in about 1,000 different ways. Genius, sociopath, visionary, villain. He had one simple idea that changed everything. What if Enron didn't just sell gas, but sold the idea of selling gas? Think of it like this. Instead of selling you a meal, they'd sell you the reservation for a meal, plus the bet that someone else might want that reservation later, and the gamble on the future value of that reservation in a different country's currency. Confused? Good. That was the point. The more complicated it sounded, the smarter Enron seemed. Skilling introduced mark-to-market accounting, which is basically like telling your friends, I could sell my old car for $10,000, so I'll just write it off. Down $10,000 profit in my notebook today. Never mind that the car is actually worth half that. The dream counts as reality. Wall Street ate it up. Enron's reported profits exploded. Every quarter was a blockbuster. Every earnings call was a standing ovation. The stock price soared like it had been strapped to a rocket booster. Executives strutted through Houston like rock stars. Well, rock stars who preferred golf to guitars. Inside the company, though, it was less concert and more cult. Enron's culture was basically Darwin, with a side of espresso. Skilling had instituted something called rank and yank. Every year, employees were graded, and the bottom 15% fired, no mercy. Imagine working in a place where your coworker smiling at you in the elevator might also be rehearsing a pitch to steal your job. The result? Ruthless ambition, creative solutions, and people willing to bend numbers into pretzels just to stay alive another quarter. If someone said, we made $100 million profit last week, the follow-up question wasn't how, but can we say it was $200 million instead? And investors? Oh, they were in love. The suits on Wall Street treated Enron like the golden child of capitalism. This wasn't just a company, they believed. It was the future. Enron was in energy trading, broadband, weather futures, water, international power plants. One executive famously claimed Enron would become the world's first trillion-dollar company. Trillion with a T. To put that in perspective, that's more money than most small countries. Enron built a 50-story glass tower in Houston, the famous Enron building, gleaming like a crystal palace in the Texas sun. Employees got rich on stock options. Executives got richer on bonuses. And Fortune magazine kept handing out those most innovative trophies like candy at Halloween. Meanwhile, if you peeked behind the curtain, the picture wasn't nearly so glossy. Deals weren't making money, projects overseas were stalling, and Enron's new broadband venture, designed to reinvent the internet, was less innovation and more money pit. But with mark-to-market accounting, those failures didn't matter. Losses were hidden in shadowy off-the-books entities, with names that sounded like rejected Star Wars droids. JEDI, Chuco, LJM, These were special purpose entities, basically accounting hideouts where Enron could stash its debt like dirty laundry shoved under the bed before company arrives. On the balance sheet, Enron looked like a lean, mean money-printing machine. In reality, it was drowning in obligations. But hey, Wall Street didn't ask too many questions because Enron's stock kept going up. Analysts wore their strong buy recommendations like badges of honor. Even when a few skeptics raised eyebrows, they were drowned out by the chorus of cheers. After all, who wants to be the guy saying the emperor has no clothes when everyone else is admiring the suit? At one point, Enron was worth more than $70 billion. It was the seventh largest company in America. Its executives strutted into Washington with political clout to spare, whispering into regulators' ears, shaping energy policy. They weren't just playing the game, they were writing the rules. But here's the thing about illusions. They demand constant upkeep. It's like juggling chainsaws. The moment you flinch, everything comes crashing down. And by 2001, Enron was wobbling. Whispers of trouble started leaking out. Analysts began to quietly ask, wait, how exactly does Enron make money? A question that, hilariously, Enron executives struggled to answer without turning it into a TED Talk of nonsense. One story goes that Skilling was asked on a conference call to explain Enron's business model in plain English. His reply? He called the analyst an asshole. Not exactly the confidence-inspiring transparency you want when billions of dollars are on the line. By that point, though, the cracks were forming. The empire of glass and jargon was about to meet reality, and the fall, when it came, would be spectacular. By the summer of 2001, Enron's shimmering tower of innovation was beginning to creak. The headlines were still glowing, the stock ticker still flashing like a Vegas slot machine. But inside the company, the smell of smoke was hard to ignore, and soon, the fire alarms would be blaring. Here's where the story turns from Wall Street fairy tale to Greek tragedy. Remember those special purpose entities? The JEDIS, the CHEWCOS, the alphabet soup of partnerships where Enron hid its debt? Well, those weren't just accounting tricks. They were ticking time bombs. The man running many of these entities was Andy Fastow, Enron's chief financial officer, who somehow thought it was a good idea to negotiate deals with himself. Imagine hiring a referee for a championship game, and that referee also happens to be the captain of one of the teams. Fastow built a labyrinth of shell companies that made Enron look flush with cash while quietly burying billions in losses. It was like a magician sawing a woman in half. You know it's a trick, but the audience is too dazzled to question the bloodless ending. But then, in August 2001, the first real crack split the illusion. Jeff Skilling abruptly resigned as CEO. Officially, he claimed it was for personal reasons. Unofficially, everyone smelled trouble. When the supposed genius behind your financial empire bolts after just 6 months in the top chair, you don't need an MBA to know something's rotten. From there, things spiraled. Analysts, once content to nod along, started poking harder. The Wall Street Journal published exposés. Credit rating agencies grew uneasy. Even Congress began sniffing around. And Enron's house of cards, once stacked so carefully, began to sway. By October 2001, Enron announced a $618 million quarterly loss, its first in 4 years. Investors gasped, and the stock price collapsed like a souffle in a thunderstorm. A few weeks later, they dropped another bomb. $1.2 billion had simply evaporated thanks to those sketchy partnerships Fastow had set up. That's billion, with a B, gone like loose change slipping between couch cushions. The fallout was swift and brutal. Enron's stock, once trading at $90 a share, plummeted below $1. Employees who had been encouraged, heck, pressured, to put their retirement savings into company stock watched their nest eggs vaporize. One day they were millionaires on paper. The next they were jobless, pensionless, and angry. Picture it. Thousands of employees filing out of that gleaming glass tower in Houston with cardboard boxes in hand, while executives at the top had already cashed out millions. The anger wasn't just financial, it was personal. Enron had convinced these people that they weren't just workers, but partners in innovation. Turns out they were collateral damage. And then came the nuclear blast. Enron filed for bankruptcy in December 2001. At the time, it was the largest bankruptcy in U.S. history. Over $60 billion in market value evaporated. Banks, pension funds, and mom-and-pop investors all got scorched. And Houston, once proud to house America's most innovative company, now had the corporate equivalent of Chernobyl sitting downtown. The collapse set off shockwaves far beyond Texas. Investigations uncovered not just shady accounting at Enron, but also complicity from one of the world's most respected accounting firms, Arthur Andersen. They weren't just signing off on Enron's books. They were shredding documents once investigators came knocking. Within months, Arthur Andersen, a 90-year-old institution, disintegrated. 28,000 employees lost their jobs because their bosses couldn't resist enabling Enron's lies. Congress went into overdrive, dragging executives into hearings. There were sound bites that could have been ripped from a dark comedy. Lawmakers asked Enron executives to explain what their company actually did. The responses were a masterclass in word salad. "We create markets," they'd say. "We enable efficiencies." Translation: "We have no idea how to describe this scam without admitting it's a scam." Jeff Skilling was convicted of fraud and insider trading. Andy Fastow pleaded guilty and testified against his colleagues. Kenneth Lay, Enron's original ringmaster, was convicted of conspiracy and fraud, but died of a heart attack before sentencing. Justice in this story was messy, incomplete, and unsatisfying. But Enron's ghost still lingers. Out of the rubble came the Sarbanes-Oxley Act, new regulations designed to keep companies from playing accounting hide-and-seek with investors' money. Wall Street tightened its auditing rules. Enron became shorthand for corporate fraud, the same way Watergate became shorthand for political scandal. And yet, ask yourself, did we really learn? Less than a decade later, the 2008 financial crisis exposed banks doing cartwheels with toxic mortgages. A couple decades later, crypto exchanges were vanishing overnight with billions in customer funds. Different logos, different lingo, same old story. Hype, greed, collapse. Because here's the truth Enron taught us. The bigger the number, the bigger the lie people are willing to believe. When the stock ticker keeps going up, skepticism feels like a buzzkill. And when a CEO tells you, "We're the future," it's tempting to nod along, even if you don't understand a single word of their PowerPoint. In the end, Enron's legacy isn't just a cautionary tale of fraud. It's a mirror held up to our financial culture, one that rewards complexity over clarity, hype over honesty, and short-term gains over long-term sanity. Or, put another way, Enron didn't just fool everyone. Everyone wanted to be fooled,